Welcome back to your ultimate pit stop, Piston Pundit. Today's story isn't just about a car company, it's about a nameplate stitched into America's DNA. Chevrolet, the everyman's badge, once defined driveways from Michigan to California. But under tariffs, fractured supply chains, and cutthroat global rivals, Chevy's American dream is stalling. Factories have gone dark, communities are hollowed out, and GM is shifting its playbook from volume to profit, betting everything on SUVs, trucks, and regional survival. From Trump's policies to China's rise, every turn has reshaped Chevrolet's fate. Buckle up. We're breaking down the forces that pushed Chevy off its home turf. Chevrolet's assembly lines go silent. Factories, families, futures. Chevrolet's decline didn't begin with boardroom memos, but with the silence of factory floors. The Lordstown plant built its final cruise, closing a chapter of Midwest pride and middle-class mobility. Soon after, Detroit Hamtramck and Warren Assembly, once tied to Chevrolet's sedan legacy, went dark, leaving communities hollowed out. Diners that bustled before dawn, schools funded by union wages, and local teams supported by Chevy workers all felt the blow. For decades, Chevy was America's everyman brand, the Impala for families, the Volt for early EV pioneers, the Cruze for efficiency. Their retirements weren't just product shifts. They signaled GM's global strategy, leaving tradition behind. Even the Silverado, Chevy's workhorse, leaned on parts from Canada, Mexico, and overseas. Executives called it optimization. Workers called it layoffs. Tariffs only deepened the cracks, exposing how fragile Chevy's U.S. identity had become. Once a symbol of resilience, Chevrolet's factories now stand as stark reminders of policy's unintended consequences. And while shuttered factories showed the human cost, the next blow came from policy itself. Tariffs that hit Chevrolet harder than anyone expected. Tariffs hit Chevrolet hard, costs rise, loyalty tested. Tariffs were sold as protection for American icons like Chevrolet, but they hit the brand harder than they helped. Trump's 25% duties on cars and parts slashed GM's income by $1.1 billion in a single quarter, a staggering 32% drop. Chevy, with its globally sourced lineup, took the brunt. The Trailblazer from Korea faced nearly $6,000 in tariff costs, while Canadian-built Equinox and Traverse models became liabilities. GM kept sticker prices flat to shield buyers, but the sacrifice drained billions and sent GM's stock tumbling 7% in one day. Even made-in-USA Silverados weren't immune, their brake systems and electronics crossing borders and stacking tariff bills. Consumers grew wary. Headlines warned of Chevy price spikes, families hesitated, and dealers leaned on incentives just to move cars. Ironically, policies meant to protect Chevrolet's American identity instead made it less competitive. But tariffs weren't the only storm. Chevy's global supply chain soon buckled, leaving assembly lines vulnerable to disruption. Before we delve deeper, do us a favor and smash that like and subscribe button. This helps us reach more auto enthusiasts just like you. Supply chain breakdown. Chevrolet struggles under tariff pressure. Chevrolet's global reach, once its strength, became a liability under tariffs. A Traverse mixed Canadian stampings, Mexican interiors, and Korean electronics before hitting U.S. showrooms, but every border crossing now added costs and delays. In Mexico's Silao plant, where Silverados are built, workers demanded raises as expenses rose, but GM cited tariffs to hold wages down. In Oshawa, Canada, Chevy lines stalled, while Tennessee's Spring Hill faced repeated shutdowns on EV crossovers. Even the Bolt EV, billed as Chevy's future, was derailed by shortages and tariff-related delays. Suppliers struggled too. Tier 1 firms absorbed steel surcharges, while smaller Tier 2s collapsed under volatility, creating bottlenecks that idled thousands of Chevrolets and cost GM millions daily. Workers on both sides of the border grew frustrated. Mexican line techs trapped in low wages, UAW members watching shifts vanish. Their question was the same. If tariffs were meant to protect jobs, why were Chevrolet communities paying the highest price? With supply chains stretched thin, GM pivoted to a survival strategy. rebuilding Chevrolet's future around profit, not volume. Profit over volume. Chevrolet bets on trucks and SUVs. GM's survival strategy put Chevrolet at the center, but it meant redefining the brand. CEO Mary Barra's new mantra, profit over volume, focused on Chevy's most lucrative models, even if it required cutting back elsewhere. The counterpunch began with Chevrolet's strongest assets, the Silverado and full-size SUVs like the Tahoe and Suburban. These profit machines could weather tariffs and still deliver strong margins. GM expanded production in Indiana and Texas, pledging $4 billion to strengthen U.S. capacity, with plans to return Blazer and Equinox assembly stateside by 2027. The trade-offs were tough. Sedans like the Cruze and Impala were gone, limiting affordability for entry-level buyers. On the EV front, the Bolt was paused, and the Equinox EV rollout slowed, shifting from bold ambition to cautious realism. Partnerships changed too. Honda's Acura EV plan collapsed, freeing resources for Chevy. Still, by leaning heavily on trucks and SUVs, Chevrolet risked falling behind rivals in innovation. Yet survival in today's auto market isn't just about profits, it's about geography. Chevy's future will be fought region by region. A regional future. Chevrolet defends home, rivals advance. Chevrolet's future won't be defined globally, but in regional battles. The era of one-size-fits-all cars is over. Tariffs and trade wars pushed GM toward local production. Chevy's built in America for Americans, in China for Chinese buyers, and in Latin America for emerging markets. This pivot brings both promise and peril. Returning Equinox and Blazer assembly to U.S. plants strengthens Chevy's Made in USA identity, a selling point for dealers. But shrinking globally risks ceding ground as rivals expand. Ford's F-Series dominates at home. Stellantis fine-tunes Jeep imports. Hyundai invests in U.S. battery hubs, and China floods developing markets with cheap EVs once contested by Chevy. Regionalization reshapes the lineup. Silverado and Suburban remain fortress models in America, while EVs must be carefully paced to avoid oversupply. Policy adds volatility. Tariffs can boost Chevy overnight or erase margins instantly. Which brings us to the big question. Verdict: the road ahead. Can Chevrolet survive America's auto storm? Chevrolet's collapse in the U.S. is more than one brand's misfortune. It's a cautionary tale of politics, economics, and globalization colliding. Tariffs meant to protect drained billions, hollowed out supply chains, and left once-thriving Chevy towns struggling. GM's reinvention, profit over volume, regional focus over global reach, feels more like survival mode than a bold comeback. There's still hope in Chevy's fortress products like the Silverado, Tahoe, and Suburban, along with billions pledged to U.S. production. Yet rivals such as Toyota, Hyundai, and Tesla are racing ahead, while China floods emerging markets with cheap EVs. Add in volatile policy and fading EV tax credits, and Chevy's road forward looks anything but smooth. The next few years will determine if Chevrolet can rebuild faith in Made in America or mark the start of a broader unraveling of U.S. auto manufacturing. Now, over to you. Will profit over volume save Chevrolet, or just buy time? Can regional production restore Chevy's American identity? Have tariffs protected jobs or punished communities? Drop your thoughts in the comments. Before we wrap up, hit that subscribe button to stay updated here at your ultimate pit stop, Piston Pundit. Thanks for tuning in, gearheads. Until next time, keep your engines running and your insights sharper than ever. You can now check out any of the videos on the screen. There's plenty more to explore.